First quarter ended with a bang, but we believe just another bear market bounce. This week, earnings coming out in a big way. It is going to tell the true story of what we see coming next. Lots to talk about. Sit back. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor, have a registered investment advisory firm, meaning we act as a fiduciary. What you see in these videos, we apply to our portfolios. So if you like what you hear, please do consider subscribing. So in the intro, talked about it, right? Bear market bounce, we believe. I'm going to show you that in a second. But this week, earnings is coming, okay? Our theme, first quarter. Now, reiterating second quarter, earnings recession in a big way. And that is going to take us to another side of the market we haven't seen in a while. So, lots to talk about today. We're going to go through our cycles, the charts, and then offer a game plan going forward. Let's go to the big charts. All right, first up, I'm going to start with something a little bit different. I do these in our client private videos all the time, but a nice little quote here. There was never a show of panic or an inclination to abandon the game plan. They were never rattled when they were behind. I'm certain that the thoughts of defeat never entered their mind. The famous John Wooden, that is all about what? Process. And that's exactly what we focus on here. Process. We've got several pieces to it, lots of research, institutional research, which then drive our cycles. So let's start here as we always do, right? 4 cycles like the 4 seasons, not the singers, the weather, okay? Now, within those cycles, we have growth, inflation, and policy. There is only one cycle that we are risk off. That is cycle 4 right now. Made that call going back in December of 2021. Okay, so we're going to talk about that today. We are still solidly in cycle 4. Next, yes, we do see a cycle 1 coming, but a little bit further out than we originally anticipated, probably later this year. So let's get into some of the stats behind it. First up, growth. Now, there's a lot of different factors in here. In fact, over 30 factors that apply to growth, but most look at GDP, okay? You can see how we peaked, right, a couple years ago, slowly have come down. Eventually, we anticipate negative GDP growth, okay? Obviously, when you look at growth, you think of earnings, right? Talked about a profit recession coming. Now, a week ago, end of the week, no one talked about this because they're all gaga about the bear market bounce. Micron Technology is one of the few companies that reported early in the tech space, okay, minus 52%. Wow. How about Thursday night heading into a long holiday weekend? Samsung cut chip production after profits plunge 96%. Now, the street's looking for about a -5, about a -3 over the cycle here. No chance, okay? Through Friday with just 5 tech companies, negative 75%. Overall, S&P, we're up to 17 companies that have reported, minus 27%. Okay? Not saying that's the final number, but a thing of the story that we're talking about. Okay? Next up, manufacturing. This was a big thing this week. Okay? Bad news is starting to be bad news. Now, sometimes you get bad news. It's good news for the markets. But now bad news is bad news. What do I mean by that? ISM came out this week. Manufacturing below 50 means you're contracting, more recessionary, okay? Underwhelming, 46.3, okay? Same goes for ISM orders, okay? So a couple things on that. That's the slow. That's the slow we've been talking about, okay? But ISM orders, you can see that. That can also affect inflation. We'll talk about in a second. But then we had ISM services. Now, on both of these days, with these reports, you saw the markets, the bond market go down. Yields go down, which we've been talking about for quite some time. So ISM services is a laggard, right? Lots of services in the retail, restaurants, etc. And yes, we are finally seeing that come down. Last month, we had a number that was a little funky, probably because of holiday short-term hiring, but this is what we see breaking down next. And then ISM services, new orders. Same thing, starting to come down. So a couple of different pieces there. Now, both of those can drive inflation lower, okay? And here's our inflation numbers. Not too concerned about the OPEC announcement this week. Why did they do that? Because we're slowing, right? Demand is slowing, so they were trying to reduce production. Short term, had a little price jump. We'll see. We feel it still is going to go lower, but we'll track that if it's an opportunity as we go forward, okay? Next thing, we talked about profit recessions. Credit events was one of our themes for the first quarter. Obviously, we saw that in a big way in the bank sector. May have heard Jamie Dimon this week say he feels there's more to come. We would agree with that assessment. But the next part of that is really going to be commercial real estate. Already starting to see it. Blackstone defaults on Nordic mortgage-backed bond, okay? Just stopped paying it. Over here, PIMCO saddled with 1.7 in defaults in the office market, okay? Big time here. RXR looking for debt payments on several Manhattan properties, ready to turn in the keys. Just walk away from $500 million in properties. And just from this morning, recording this Saturday morning, Morgan Stanley analysts are forecasting something worse than in the great crisis for commercial real estate. So you've got a couple issues here. You've got $1.4 trillion in debt coming due, okay, this year and next year. Why is that important? Because the debt they were servicing was probably 3.5%, 4%. Now rates are looking at 8, 10, 12%. You have occupancy rates soaring, cycle high, almost 20%. San Francisco, 29%. And you have a glut of buildings because of the hybrid situation. So commercial real estate, we think, is the next credit section to go. Real quick touch on this, the Fed balance sheet. I put this post out. If you don't like or follow us, make sure you do, okay? I put out stuff like this, but we saw this spike on the balance sheet. Everyone was saying, oh, this is QE, right? One of the reasons the market went up at the end of the quarter. It was not quantitative easing when they were buying bonds. This was part of the bank crisis where they were taking bonds, some of these bonds that had unrealized losses from the banks, taking it at par, at value, okay, putting it on their books, and then they were lending back the cash to the institutions, but at 5%. So this was not quantitative easing. This was just the Fed stepping in as far as, right, helping with this bank crisis, all right? Next up, nice little picture here from our friends at HedgeEye. This shows you going back to 74 when interest rates were really high recession. Arthur Burns was the Fed chair. I've shown this many times. But it came down, just like it's coming down today, right? The problem is he pivoted, and then we went to an all-time high, almost 15%. That's when Paul Volcker came in, okay? That is what the Fed is trying to avoid. We got a pretty strong unemployment number on Friday. Probably see another rate hike, okay? Came in on Friday, market was closed. Should be interesting come Monday morning. But when you look at those Fed pivots, you got to be careful. Past performance not guarantee future results, but this shows you, bottom line is Fed rates, okay? And it shows you each time going back to 65, the Fed has pivoted, and it is not pretty, okay? Each time they've pivoted, that's when the market rolls over. Why? Because basically they are admitting things are slowing and they need to start cutting those rates. So be careful what you wish for. Let's go to those big charts. All right, real quick, going to roll through this. So our process, we have the cycles driven by data, macroeconomic data, and then we follow that up, confirm with the charts, because the charts are showing momentum, okay? We've got 3 different periods, 3 years or less, 3 months or less, 3 weeks or less, okay? So on the long-term view, this is your S&P monthly. Okay, is there anything that we see here? We still have not come above that. So again, still showing our downtrend. are not showing. That's momentum. MACD, you look for that crossover, not seeing that. Therefore, at this point, we are still negative on the long term. On the midterm view, okay, looks a little bit more positive, all right? But again, when I focus in here, you can't get above that line. Yes, we've had some momentum crossovers down here, but not driven by enough volume to prove to me that that's bullish in any way. So midterm at this point, also negative, okay? So then you've got the S&P. Here's why I show you why it's still a bear market bounce, right? You can see the trend line, okay, still pretty much down, okay? And you see we're down 17, 12, etc. Then we have these bear market bounces. The most recent one, only 6%, so pretty small compared to some of the others, okay? What else do I see in this chart right now? This looks like, hold on, turn on my tool here. 1, 2, 3. That's what they call a head and shoulders, right? You see your left head, your left shoulder, head, and right shoulder. That is a bearish move, okay? So we're looking at that and see how that forms, okay? And then down here, a couple other things, right? Companies above the 50-day moving average, only 200. Let me move that. 222, so not a lot of companies above. So again, not seeing that thrust, okay? Yes, we were short-term trade was positive, but I'm not going to trade that. I'm looking for the trend to change. So that's why we feel we're still going to roll over, especially with the earnings picture that we've just talked about. NASDAQ, what's going on here? Same with the S&P. This move has been driven by what? The FANGs, right? Maybe not called the FANGs anymore because it's not Facebook, it's Meta. But I'll also show you they went in at the end of the quarter, meaning this flight to quality people were saying. Crazy, right? It wasn't long ago that all these companies were missing earnings. I'll pop up the revenue and look at that, right? Straight down. Don't anticipate that as we go forward, meaning growth, it's going to slow, okay? I already showed you two tech companies, and look how much they are down. Going to be real interesting. Needless to say, we're on the other side of that trade as we head into the quarter. Last up, the market breadth, okay? What, if anything, are we seeing? Nothing, okay? When you look at this, hopefully I don't lose my charts, right? So the blue line is the NYSE, so the entirety of the market. The histogram, okay, is new highs minus new lows. And you want to see that surge, right? When you're above, that tells you you've got a lot of companies growing. When we hit peaks over there, we're talking about in the 950, 960, okay? Last week, when we had that little push heading into the end of the quarter, 45. 45 new highs minus new lows, so no market breadth there at all. Next up, let's go to Sector Spotlight. Like what you hear? Again, don't forget, please do subscribe. We also have a new podcast, latest up here. Subscribe for both. Let's keep going. All right, so sectors. We've talked about this for quite some time. When it comes to the bond market, right, when you go back here, you see it going up, right? Yields go up, prices go down. Talked about this many times, right? So you lose value, right? Yields up, price down. Pretty obvious. In the bond market, showed this last year, the 60-40 portfolio had its worst year in history because bonds got hit really bad. Okay, so we've been out of bonds based on our process. When we look at the cycles, again, this is a risk-off type of cycle. Historically, cycle 4 is very good for bonds, but with inflation so high, it has driven bonds higher. But that is now finally changing. The trend has changed, okay? So for us, what we've looked at over here, right, again, we've gone up. Okay, it looks like an opportunity. Nope, head fake, down, up. Okay, so it's been very difficult, but over here is when the credit crisis started with the banks. Okay, we finally broke trend. That is when we started adding back bonds, okay? When I look at bonds, this is an opportunity. We'll go as much as 12% per position. We've got 4 different bond holdings right now at different durations from intermediate up to long term. So we'll see what happens. CPI report coming out next week, but I don't think it makes a difference. At this point, the story is the profit recession, the earnings recession. It's coming, the slowing that we're seeing across the board. And that is what's going to drive yields down and prices up. So what else are we looking at? Well, if you see treasuries, okay, you got to take a look at gold. Now, let me go down here at the bottom of the chart. Correlation to the 10-year. Correlation if you move together. If you have a 1 correlation, you're moving together, okay? Correlation between the 10-year and gold is negative 0.83. Was 0.93 just a week ago. So they're negatively correlated. So when yields go up, okay, excuse me, when yields are going down right now, gold prices are going up, okay? So that is one of the reasons that we are owning gold, okay? We started buying gold back here in November, very fortunate. All right, took some profits over here, but then we started buying again when yields started rolling over. Now, I will caution you, I think we're a little bit overbought. I did add a little bit more on Friday, not a full position yet. Just like bonds, I would go as much as 12%. So we're waiting to see what happens here. If we have a little more consolidation, I'll continue to add as we see this flight to quality, okay? Same thing goes for silver, but up top here, way overbought. Not the time to buy silver. Looks like we might be consolidating here. If we do, that would be a time to add, or if we see some type of minor pullback, chance to add there. But we look at gold as a currency, so we'll do 12%. We look at silver as a commodity, a little more volatility, okay? So max position there is 4%. And then you've got the miners, all right? So you could go gold or silver miners, whatever the case might be. I'm just showing you gold miners. We were in, then we got out, started buying again. Couple things here. I will caution you. One, it is way overbought, okay? Not a time to jump into gold miners unless we see some type of pullback or consolidation. The other thing is gold miners for us is a equity max position 3% because as you can tell, we had a great run, okay, when we started buying back there in November, December, okay? We started selling, trim, got out of it, okay, and it came down pretty hard. Again, more volatility, okay, and then we started adding again a couple weeks ago. So do like the gold miners as we go forward, but looking for that opportunity. Let's wrap this up with game plan going forward. All right, going to wrap this up, but before you go, please do consider subscribing. So where are we on this cycle? You've seen these before. Oh, you're enthusiastic. Greed. It's a new paradigm. We saw that, right? Bottom line is that's where we were a year ago, and we still are the mother of all bubbles. Everything is still inflated right now, okay? So we've turned over. We've rolled over. Right now, I believe we're at the bull trap stage. That's what happened at the end of the quarter. Got sucked back in. That FOMO, right? Fear of missing out. Had a lot of retail investors coming in. Can't miss out. End of quarter. You got the money managers doing some window dressing, okay? But this week is going to drive the reality when it comes to the earnings report, where I think we're going to start seeing some fear. But you don't end until you get the capitulation and everyone's selling out, and we're not quite there, all right? So what are we looking at here? Game plan. Cash is king. Now, right now, because of what's going on, you've got treasuries, right? You've got 1 year, you got T-bills. Money markets are not a bad place to be right now. Good safe haven, depending on your brokerage, okay? We use Fidelity as our custodian, paying about 4.5%. We've got a bunch of ultra short bonds, paying a little bit more than that. So that's the majority of our position. Then we've got duration, talked about that. Long bonds, starting to get into that. The precious metals, and then inverse shorts, okay? So if the market goes down, can you take advantage of that? Now, before I do that, there is some risk associated with that. I also did a video, I'll put it up here, about how to hedge in downtrends. Because of the kind of business I'm in, meaning with working with clients, I'm not doing options and shorts. It's too difficult with a book of business. So we use inverse shorts, okay, as things roll over to take advantage of that. So places like credit, what we've talked about, I think the NASDAQ's way overbought, and some other areas where we'll be going into this quarter, but they are trades, meaning the inverse shorts. We're trying to get in, get out, make a little bit of profit and move on. So thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.